This podcast is for financial professional use only and is not intended for use with the public. Material is for informational purposes only and is not intended to provide tax, legal, or investment advice. The opinions expressed in this podcast are those of the participants and do not necessarily reflect the views of Ash Brokerage. Welcome to Accumulation to Activation, the podcast that breathes life into your retirement planning strategies. If you're an advisor aiming to elevate your practice, deepen client relationships, and stay ahead of retirement income trends, we'll help you capture the opportunities on your doorstep and increase your impact. Each episode, we'll unpack the forces reshaping our industry, from the $44 trillion generational wealth transfer and the evolution of income planning to behavioral shifts, legislative updates, and breakthrough solutions that redefine financial security. Here are your hosts, Mike McLaughlin and Tim Ash.
Hello, everybody, and welcome back to Accumulation to Activation, where we talk with Tim Ash and get different ideas on the whole world around employment to enjoyment. We've spent a lot of time talking about longevity and all the risk and things like that. We want to talk about some possible solutions because we talked a lot about the legislation, a lot of problems and things like that. So again, thank you everyone for joining and listening to the podcast. If you find this podcast useful, I encourage you to like and subscribe to us. So welcome back, Tim. How are you doing today?
I am doing better than I should be allowed to. Just having a great time with you on this series on this episode 6. It's hard to believe that we're here, but I want to thank you for your thought leadership and give you a pat on the back and a kudo for always being in the forefront of education and delivering great content to our advisors so that they can go out and serve their clients. And to all of you advisors that are listening to this and subscribing to this and liking this, we hope, thank you. We don't exist without you. And like you, we care deeply about your clients and the end outcomes that you're delivering to them. And our job is to try to bring best ideas, best concepts to you to be able to serve them.
Yeah, thank you. And, that's the beauty of Ash Brokerage and what we've invested in people and process. Obviously, we have the technology to process everything, but most importantly, we have people, highly educated people, highly trained on a lot of different things. But at the end of the day, financial planning and transferring those qualified assets from one generation to the next generation is a complex issue with a complex tax code. We're going to talk today about a really simple strategy that you have actually talked about at dinner tables and had unbelievable success with. But first of all, I want to set the stage about what's different today than in 2020 and before. And when we talk about life insurance and annuities, so many times those are kind of a teeter-totter. But we've actually got a rate environment right now that helps both. From the retirement side, higher interest rates help higher annuity rates, higher payout rates, so that there's more income coming off every dollar. But on the life insurance side, what does higher interest rates mean to a life insurance contract and its pricing, Tim?
Yeah, well, this one's going to be a lively conversation. And let me answer your question that you asked. What do higher interest rates mean to an insurance company when they're pricing a life insurance product? It means lower reserves. Lower reserves mean lower life insurance premiums to provide that mortality-based product for a consumer over their lifetime. So let me throw this out there. How many of you listening to this podcast right now, and McGee, I'll throw it out there to you and I'll throw it out to me. If you could get a 15-year mortgage at 2.5% right now, today, would you?
Jump on it.
Okay. So the world around the financial services space refinanced their mortgages when rates were zero on the 10-year, not the 10-year, but pretty close to zero but a zero interest Fed policy. So what did that mean to annuity products that were sold in that regime?
They were
Payouts were
super
this.
low payouts and thin payouts. Exactly.
So why have we not, and that's a rhetorical question, why has the industry not said, hey, wait a minute, I sold an annuity when the 10-year treasury was 1.75%, and now it's 4? I know it's teetering on 4. Guess what happens? And I got long-winded here on you because you asked me how it affects life insurance, but we should be refinancing annuities right now because rates have gone up since they were sold. And the pressure that the life insurance industry felt with that low rate caused pricing to go up and products to leave the market. Well, now we're seeing those products back in. So maybe more than what you wanted to hear from an opening statement, but I'm telling you, the timing couldn't be better right now.
Yeah, and I think, I mean, you hit the nail on the head. What I want everybody to understand is that specifically in the annuity world and in my space, it, it doesn't mean that that product was bad 5 years ago. It was absolutely appropriate for that client when the interest rate was 2.75 on refinancing your 15-year mortgage. It's different today. And it was absolutely appropriate at a 4% distribution because that was the best distribution that was available during the pandemic. Today, that number is closer to 6 to 6.5, given the same scenario. Like, why don't we do that? And if you're not doing that, that's where you need to give us a call, leverage our technology, leverage our expertise, and really be able to start 2026 with a terrific year as you're listening to this. But also, I want to go back to the basics, and the premise of this podcast is the impact of qualified funds. The taxation from one generation to the next generation is going to be horrific and maybe one of the greatest tax erosions, I think, in the history of the United States. And we've got a way now with better insurance rates and better payout rates to mitigate that, called annuity arbitrage. And so if you want to walk people through just kind of the general basics of that.
Sure, I'd be happy to. And before I do, I want to talk about. I think advisors get stuck because they feel like they sold a product that is now better. Now, you wouldn't say that in the mortgage market, right? Was that mortgage bad when it was 6%? Or was it what was available at the time? It's what was available. And everyone jumped to refinance when the rates dropped. And that's all this is. We offered you the best solution in the interest rate environment we were in based on what we could offer as a solution. And now, guess what? It's your time to refinance. So, in any event, I don't want to belabor that point, but I want to give talking points to advisors because I think we see this day in and day out. I know our sales folks do. They're like saying, "Well, gosh, I don't know. I don't feel like I should go out and talk to my client about this because it might look bad on me." And I think it's because the context of the conversation needs to evolve. Interest rates are going to go up, they're going to go down. We don't know which way, when, and how fast, and what it all means. But what we are educators to financial advisors on how to have conversations, but also look to the best interest of the client using solutions that are available in the environment we are in. So that sounds like a commercial. I apologize, but I think it's important. The use of phrases and being prepared to go out and talk to your clients is important. So now let's talk arbitrage for a minute. So this storm, which is a good storm, interest rates being higher takes pressure off life insurance pricing and improves payouts on annuity products. this is the perfect arbitrage, if you will, whereby you get a higher payout on the annuity and a lower payment on life insurance, and you can earn the difference, if you will, between what the payout is and what the payment is. Now, as we've said, Mike, qualified plans are going to be spent, or they're going to be lost, or they're going to be given away, whatever words you want to use. What we'd like to say is, how do we equip the advisor to say, hey, what if we could get you close to a 7% guaranteed for your client's lifetime return? And people go, oh, that's too good to be true. Well, actually, it's not, because the payouts on annuities are here and the life insurance is here. And we know how to manage the underwriting and manage all of the things and the steps that go into it. We know it's not easy. So the job is for you to say, I have clients that are reasonably healthy. We don't need preferred plus. We do this on standard risk mortality, and show you how we can take qualified money and convert it into, almost like, I'm going to call it, a Roth for life for clients. And that's really what it is. And trust me, if I could own a Roth IRA on all my assets, game over. I don't need life insurance. I don't need this. I'll take the Roth. Well, guess what? There are limits on it. And with this strategy, there are no limits.
No, I think those are excellent comments. I think that part of this thing that we also need to talk to clients about is taking control of their own destiny, which we talked about in the previous example. But the government is clearly shrinking the taxation through the Secure Act of getting all that qualified money out from one generation to the next in 10 years. This gives you an opportunity through annuity arbitrage, as you said. And the personalized Roth is a great analogy, because you're turning taxable dollars into what's left in a legacy of being tax-free, with no required minimum distribution, no forced distribution, and you can basically control it based upon your beneficiary's needs. And so having control of that asset, for me, estate planning is not about estate taxes. Estate planning has always been control the money, spend it while I want to, and how I want to, pass it to whom I want to, and when I want to, and in what form, right? And if there's a tax savings, great. But this is the epitome of control in my mind.
I couldn't agree more. And when you talk about, and I believe I said this in one of the earlier podcasts that we've recorded, if we could have something that's tax-free forever, or maybe I'll just say this, I have 3 kids, right now 2 grandkids. The other 2 kids need to get after it here, if you will. They're married, and I really like my kids, but I love my grandkids. And this is a way that you can set up this generational wealth, and let us help you do it. It doesn't have to be with a lot. And there's another concept that we've worked on with a really large registered investment advisory firm. And, we've coined it, I'm going to call it borrowed, the family bank. How do we set up a family bank and use these qualified assets and the strategy of arbitrage to do so? And I think that's where the advanced planning resources of Ash brings these ideas to the market. That would be for our life insurance and our ramp team in the annuity side, to bring concepts, bring ideas of how we create arbitrage and ways to use assets that could be better levered for the next generation. And I'm, trying to have a little fun here on the podcast. I love my kids and want to see them continue to do well. And as I have more grandkids, I want to spread out the most I can from the assets. Why do I want it to be accidental philanthropy? I don't want it to be. I want it to be intentional philanthropy.
intentionality and control. There's a couple different ways in my mind that we can create arbitrage. You've done a great job of explaining the payout rate and then paying for life insurance, and there's still disposable income. With today's payout rates, we're seeing an average increase in our annuity performance review of 38% of income, meaning that if you've got a $10,000 payout, we should be able to do something better than $13,800, and that $3,800 can go to buy a lot of life insurance for sure. But what we're also finding is that clients, because they don't need as much capital, that frees up a lot of unused capital on annuities that can then be used to take off some other insurance risk, whether that is a single premium life insurance policy, but also long-term care, which is going to be a huge concern throughout the next 25, 30 years as this country ages. But for the same amount of dollars, we can get the same amount of income and then have reduced retirement risks off the table. So I think there's a lot of different ways that today's current interest rate environment benefits planning, benefits the opportunity. And even though that we're recording this early, I don't see any major event happening before this gets released that we're going to be back in an interest rate environment around the pandemic. So I'll kind of close with that. Tim, any last minute takes on annuity arbitrage? We could talk about this for multiple episodes.
Yeah, you're exactly right. We could talk about this for probably 3 or 4 episodes. And I would say this: the financial advisors today have the toughest job trying to make a client's dollar outlive them. And let us help you construct a portfolio that includes lifetime guaranteed income and that also frees up the assets that are being held hostage inside of the portfolio so that you can get creative with your assets under management. You can take a little bit more long risk because you have a backstop of guaranteed lifetime income, or you convert a portion of the assets that you have that are in appreciated annuities into an asset-based long-term care conversation, which converts it from taxable to tax-free. And I'm sure we'll talk more about that, but that's my take. We want to keep these episodes to 20 minutes or less and have them be filled with content. We want your feedback. And if there's a topic that you want us to cover, I know Mike opened with that and we close with that on other episodes. We mean it because we get better when we hear from you. And that's what wakes us up every day, is to add and deliver purpose to you as an advisor who is going to make a difference in the life of a client. That to me is why I do what I do. So with that, McGee, thank you. Always enjoy this.
Yes, and I enjoy the conversation. For everybody, we will continue the conversation after the holidays. So again, subscribe to us. If there's any topic that you want us to address, shoot us an email, let us know. Or if there's any client experiences that you want us to share, I would be more than happy to do that. Also, in the show notes, we're going to put down a link to our digital solutions room, which includes a lot of different case studies of actual cases. Carrier names have been redacted, but it can show you how much arbitrage that you can actually create. So make sure that you click on that digital solutions room to learn more and then contact our sales team. Again, thank you for listening. I hope that you have a great and safe holiday season. We'll see you in 2026 with some kickoff ideas.
This episode of Accumulation to Activation was produced by Ash Brokerage. For more on the most pressing and critical issues facing financial advisors today, be sure to subscribe, leave a review, and share this episode with a colleague. For more resources, visit us at ashbrokerage.com or reach out to our team at 800-589-3000. Let's start a strategic conversation about how you can be more efficient with your retirement income and legacy planning solutions. Insurance product guarantees are subject to the claims paying ability of the issuing insurer. Tax laws and Social Security rules are complex and subject to change. Clients should consult their tax and legal advisors. Product features and availability vary by state and carrier.